With 1 week to go until the US presidential elections, the polls are tightening in the race for the White House from what seemed to be an unassailable lead for Democrat candidate Hillary Clinton just a few days ago. Recent developments have pulled Republican candidate Donald Trump back into contention. John Butler joins us now from Gold Money, where he's going to give us some more analysis on this. And just really what I want to get your thoughts on is the market leading up to this point, because I think there's some really interesting factors going on. But first of all, a broad comment on where we are in the campaign.
Well, we're in an astonishing point, as you say. Astonishing is the right word, I think, to choose here. We're in the final days, obviously. This has been an extraordinary campaign in so many respects. The word historic is being applied to it, and I think that's fair. Now, I don't specialize as a political analyst, but I can tell you this, that clearly Trump is not a typical candidate. That is obvious. Everyone knows it. But what's happened now is that the supposedly safe candidate, I mean, even if you disagreed with her policies, you knew what they were. But now we're in this very strange situation where if she is elected, there are going to be so many lingering legal issues that will not just go away, that it will be uncertain if she can long remain in office without just being completely bogged down in crisis, without a proper mandate. And then you get paralysis. So there's so much uncertainty in both cases now. It's not just Trump that's the source of the uncertainty now. There's uncertainty on both sides.
The other thing is, of course, if Trump does win and he brings in some of his extreme policies which he was talking about in the lead-up in the campaign, there is a check and balance system within the US political scene, isn't it, to stop extreme policies from getting through Congress?
Yes, indeed. In particular in the Senate. The Senate in particular is able to slow down or kill almost anything that the government is trying to do. But in practice, it doesn't necessarily work that way. And if a president is popular enough, they can use the bully pulpit a bit and get the public on their side and get things through the Congress anyway. That's where Trump will struggle with certain parts of the electorate, but other parts they want change. They want to take risks. They're willing to shake up the system. They're angry. So we'll see what it implies. But this populism that Trump has been energized by and is himself fueling to some extent is not simply going to go away, even if Hillary wins.
Let's get back to the markets, because we're running into this. We're partway through the US earnings season, which doesn't appear to be so bad. We've got bonds trading at levels never seen before. We've got the interest rates now beginning to show a rise. We've got dollar LIBOR rates beginning to show a rise. Historic low interest rates. The markets going into this election, where do they go?
Well, that's the thing, is that even leaving the election aside, there are so many things that are happening out there that would give the markets room to potentially readjust, reprice in a very, very big way. As you point out, bond yields are still extremely low. Yet inflation is creeping up. It's creeping up in the UK, it's creeping up in the US, it's even beginning to creep up in certain parts of the euro area. And so that's a potentially unstable situation. Central banks may or may not be willing to respond to a rise in inflation because they're still concerned that growth is weak, banks are weak and poorly capitalized, and the financial system couldn't take it. And as you point out, dollar LIBOR is rising, but that has as much to do with some growing stress in the interbank lending market as it does with any specific expectations of what the Fed's going to get up to. So, leave the election aside, you've still got all kinds of potential sources of volatility out there. And the combination of potential volatility on the one hand and super low bond yields on the other is not an enticing value proposition for an investor. And this could be the beginning of a major sell-off in bonds. That is possible here.
Okay, major sell-off in bonds. What about the dollar? The dollar's been rising against a whole basket of currencies. Is that a rise for the right reason, or is that for...
Look, I mean, there are no clean shirts here, right? Every major economy has issues, including the United States, but that's the point. The U.S. issues have been maybe less evident to the mainstream. But if you look at some behind the scenes a little bit, the subprime auto loan market apparently is seizing up. The student loan market, as we know, is distressed. There are many aspects of the banking system in the U.S. that may look okay on the surface, but when you dig below, all is not necessarily well. And leading indicators are sort of pointing towards a stagflationary mix now in the U.S. of continued weak growth ahead and rising inflation. That's a terrible combination for financial assets, both stocks and bonds.
Okay, so areas of...
And for the dollar. I mean, right. If people start to see that sort of evidence, it's bad news for the dollar itself.
Okay, if it's bad news for the dollar. Is it just a question of readjusting and we find a new level, or does that all weave into the stress that's in the markets and markets are going to suffer as a result of a dollar pullback?
Well, that's the thing, is that at some point, right, people are going to look at the dollar and they're going to look at other currencies and say this has just gone too far, and the dollar's going to start to weaken again. And I think in particular sterling has perhaps weakened too much now post-Brexit. But the dollar simply as a basket looks overvalued in general. But the thing is, no one really wants a strong currency right now. And if the dollar weakens too much, then other countries will resist that and try to do something to regain an advantage. We still live in this era of currency wars.
Yeah. How about gold? We've seen a rise in gold over the last couple of days, and in fact, I think we're at levels now not seen since the beginning of October.
Yes.
Do you see that as a trade that's going to continue?
I think so. Pretty much everything we've discussed, in my opinion, the uncertainty, the volatility, the stagflationary mix of economic conditions we see brewing in multiple economies, they are gold positive. They've been historically gold positive, and it makes sense. If you're getting rising inflation, that gold can go up, and if growth isn't great, then the stock market won't do particularly well. So gold is the true alternative. It's the true alternative safe haven asset. I think it has every reason to keep moving higher.
But we've seen this morning Shell come through with earnings, for example. That's still yielding 7% in dividends. Why go into gold when you've still got so many companies providing us with excellent returns on the dividend basis?
It's never about all or nothing. It's about diversification. I would never suggest, and no investor in their right mind would simply dump their entire portfolio of stocks and buy gold. However, the fact is gold is what you would say under-owned perhaps in a diversified portfolio. Most investors have maybe 1% of their net worth in gold, or 2%. Very, very, very small amounts. And if you look again historically at stagflationary environments with banks being maybe somewhat distressed, environments where governments are over indebted, and so on and so forth, then is 1 to 2% really the right allocation, or should it be materially higher? 5%, 10%. Just that sort of decision around the margins can have a huge relative impact on the price of gold vis-a-vis financial assets.
Just to remind us again, we've spoken about this before, about how one should invest in gold. Is it just a question of buying coins, or is it a question of...
Well, there's multiple ways to do it, right? And some people like collecting coins, and I have no problem with that. But that said, beyond a certain amount, gold becomes so valuable you really do want to pay for professional storage. Some people use a safety deposit box, other people use an online gold custodian, and we at Gold Money, for example, provide that type of service for very, very low cost.
Shares? Gold shares?
Well, yes, you can also buy miners. That said, understand if you buy mining stocks, you're taking the risk of the operational aspects of the mine. Is it really as efficient as the operator claims it is? Is the gold really there? Is it going to be extracted at the expected rate? And then, of course, also there's the risk that a government might impose a windfall profits tax on gold if the price rises by a lot. So don't get me wrong, mining shares are attractive here in principle, in my opinion, but understand they do carry additional risks that gold does not carry.
So from here on, it's what? Volatility?
I think pretty much everywhere you look. It's difficult to imagine a market right now that doesn't have good reason to be volatile over the coming weeks and months.
Okay, all right, John. Thanks indeed for joining us. John Butler joined us there from Gold Money.